Well, I think for the near term in this context, maybe being 2026, I think we should expect more M&A. And one of the reasons why I say that is because on one hand, you're seeing reasonably strong equity markets and stability in rates. And, you look at treasury volatility, that's much lower. Rates may not be as low as some would like, but the rate volatility is lower. It sets a better platform. But I think the other sort of overarching theme here is that we have this K-shaped economy, but I also think there's sort of a K-shaped stock market dynamic as well. And we've talked a little bit about this in the past, Tom, but what I mean by that is that with AI and with reorienting supply chains globally, scale matters, right? Larger companies are able to sort of manage through these transitions better than smaller ones in many cases there. So I think you're going to keep seeing smaller, medium-sized companies merging to get scale so that they can survive and thrive in this new era.
And we're seeing that just with the news that Tom and I were discussing just a moment ago with Paramount and Warner Brothers Discovery. Michael, talk to us about kind of the risk outlook for 2026. Again, the stocks and bonds and commodities were just ripping in 2025. How do we set up for 2026?
Well, look, I think broadly speaking, the macro, like we have a good sort of macro setup for risk appetite, right? In terms of, we've got sort of warm, maybe hot monetary policy. We've got some warmth in fiscal policy concurrently, here on top of reasonably strong earnings growth, on top of a not perfect, but decent enough economy. There, but I think there's one big risk here for certainly just talking more about equities here than rates. But if you look at the Mag 6 or the Mag 7, that if you look at the outperformance over the last several years, that has basically matched this wonderful performance in the stock market, in the U.S. stock market here. But right now, these big companies, particularly the big CapEx spenders here, which is Meta, Amazon, Google, and Microsoft, those companies are going through a valuation transition here, where like if you look at the price earnings to growth ratio, things look great, very compelling. Price earnings to growth ratio is at 0.8 right now, low, very, very low level. But their free cash flow yields are at record lows, right? And their free cash flow yields are at record lows, not because earnings are bad or EBITDA is going to be bad, but simply because of the CapEx spend. So what I'm looking for, Paul, in 2026 is that if there's indications that the return on invested capital from this CapEx spend is not there, then you're going to have a lot of narratives rewritten, and you're also going to have valuations reset lower for these key stocks there. And that, to me, it's like a micro risk is almost a macro risk, because we're talking about, $1 trillion in spend from just 4 companies over the next 24 months. So that really flows through to everything.
Michael Purves with us for a good conversation this morning to get set for 2026. We welcome all of you across the nation, the way you listen to us. Good morning, 99.1 FM, Nathan Hager Radio in Washington, 92.9 FM in Boston, and Bloomberg 1130 in New York. But around the world on YouTube, subscribe to Bloomberg Podcasts. Make it a habit for next year when you can. It's a great live chat there, but most importantly, people watch and people listen to YouTube while it's on. That's been a huge success for us this year. Paul Sweeney with Michael Purves.
Michael, talk to us about kind of the earnings environment out there. We've had really, really strong earnings in 2025, particularly the last couple of quarters. How do you think about the earnings growth for 2026? Is that enough to support this market?
Paul, it's a tricky one, I think. If I look at the S&P as sort of like a holding company with 2 divisions in it, one of which being the big tech monsters, and then the everything else at a very simplistic level. So you can look at the SPX equal weight index, sort of a proxy for everything but the Mag 7. And if you look at that, earnings growth year over year is sort of 4%. Can it beat that? Well, it will need to have some decent nominal GDP to go along with that. That I expect. I think the harder one is whether the margins will really be there to support that. Embedded in that 4% earnings growth. That's not my number. That's Bloomberg's bottom-up consensus estimates. are record earning and operating margins, which are to a degree reflect the successful adoption of AI and productivity gains within these companies there. So I think, it's not a big number. They have beaten that number in the past, but it's also, if we run into sort of more of a stagflationary dynamic and that starts really hitting some parts of the economy, the bottom end consumer are already seeing weakness there, then I think the SPX equal weight is not very compelling. And by the way, we were talking about price earnings to growth ratios. If you look at the price earnings to growth ratio for the SPX equal weight or for a lot of value and cyclical indices in the US stock market, those are very high there. So they really need to outperform on earnings just to justify their current valuations there.
What's your appetite for the timing of the market? I mean, you've been so good about, look, you got to be in the market to play. You've been legendary on that. But is timing efficacious now?
Look, I mean, technicals are always really important here. Look, my very short-term trading call is I think we're going to have a nice sort of Santa drift up higher into year end here, probably led by large tech shares. That said, if you zoom out and you look at long-term technical charts, you're looking at us trading at high valuations at the very high end of a 15-year channel coming out of the great financial crisis there. And typically there's some significant volatility in the following year that follows that. If you're at the top end of the channel there, momentum signals are a little mixed right now, depending on what you're looking at. Generally, I think they're pretty constructive, but not as constructive as they are for gold and silver.